we have the statement of financial position for the three companies.
Prepare something called a manufacturing account, and the main objective of preparing this account is to determine what the production cost or basically the manufacturing cost. So how much cost was incurred by this company in converting these particular raw materials into what? Into finished goods or into finished products. So that cost we are referring to it as the production cost.
Prepare the consolidated
the production cost. It can also be known as the manufacturing cost.
2025.
It can also be known as the manufacturing cost. And actually, in this case, we are saying for a manufacturing entity to be able to determine the production cost which was incurred in a certain financial year. So account which is called manufacturing account has to be
by the parent company
prepared. So therefore, a manufacturing account, this one is prepared or is basically prepared to do what?
Necessary. So
we to determine the production cost. The production cost, or basically the manufacturing cost,
come up with
which was incurred in a certain financial year, or basically which was incurred in a certain way, in a certain period. So therefore, the main objective of this particular topic here is basically to know how
what we have the
manufacturing account is prepared. But it's also important for you to know that other than manufacturing entities preparing this manufacturing account, the manufacturing entities also prepare
80%
the other financial statements, the normal financial statement, which includes the statement of profit or loss,
April 20,
statement of profit or loss, and also the statement of financial position. But even before these financial statements are prepared, first of all, a manufacturing entity will have to prepare what is known as the manufacturing account. So once the manufacturing account has been prepared, then that is the only time a manufacturing entity can be able to proceed and prepare the statement of profit or loss and also the statement of financial position. So is there any difference in terms of how we prepare the statement of profit or loss, the statement of financial position of a manufacturing entity? No much difference. There is only a slight difference when it comes to the preparation of the statement of profit or loss, specifically when computing the cost of sales. Even before you look on how you prepare the manufacturing account, when computing the cost of sales,
limited purchase 50%,
the cost of the sales of a manufacturing entity. Remember, generally when computing this, we take we take the opening stock.
We are told
the opening what? In other terms, we take the opening inventory. So, but now for these manufacturing entities, usually they have three types of inventory. They have three types of inventory. We have the inventory of raw materials. We have the inventory of the finished product or the finished goods. And also we have inventory of something called the work in progress. Maybe you're going to look on what is work in progress. This will be our subsidiary, how the manufacturing account is prepared. So here, when computing the cost of sales, we take the opening inventory because this finished goods will guide you. And then in terms of how to prepare the generally, we should add the requirements there. But in this case, we are saying to prepare what the manufacturing entity sells is what they manufacture internally. So what we add here is not purchases.
Consolidated financial
is not purchases because manufacturing entities do not buy to sell; they produce to sell. So what we add here is the cost
does not apply
of the goods which were produced.
For the joint venture,
the cost of the goods which were produced. And actually, we can only be able to determine the cost of the goods which were produced by first of all preparing the manufacturing account. So I want us to look on how we prepare this account. But even before we do that, maybe there are some few terms we need to define here. One is there something called the prime cost.
A joint arrangement with another company.
The prime cost. What is prime cost? Basically, prime cost.
So I think we have
this is the total, the total direct cost which are incurred. Because it is important for you to know that this particular production cost, which are incurred by a manufacturing entity. So this production cost can be generally classified.
We have to discount it with
so we have
value
the
parent company cost of capital.
That's what you can see
cost. Given the cost of
and number two, we have the indirect
for the purpose of
cost.
The present value.
The indirect
so
cost
I want us to go
to the factory
the
of
additional information now. Let's go to
number one as the factory
and in note number one.
So when we talk about the direct
date of acquisition,
these are those particular costs
the date of
basically varies with the level or basically with the fair value of
with the
change in the level of production.
Now is the subsidiary.
the change in the level of production. Anytime the level of production changes, this particular cost will change. A good example is the cost of raw materials. So if the company is not producing any units, the company does not need to buy raw materials. And then if the company is producing 10,000 units, raw materials must be bought. If the company increases the number of units to be produced to 20,000, automatically the raw materials to be used will also do what? And then the cost of raw materials is a direct cost. It always change in the level. It means production. We also have other costs known as the direct labor cost, like the wages which are paid based on the time an employee has worked. Not the salary, because salary we know they are fixed. Salary fair value adjustment. So, but wages which are paid on the time. And actually, we said once the subsidiary company value the asset. So therefore, the production cost we are saying is generally classified. As a result of that, the direct cost, which are the costs which varies proportionately with the level of production. And then we have the indirect cost on the factory side. These are basically the adjustment costs which are relating to the evaluation fee. They do not change. Even if the level of production changes, this cost do not change. A good example is something like rent. So therefore, we need if a company is paying a rent of that is 2 million every month or every year, so whether the company produces or not, rent has to be paid. So it's a fixed cost. The fair value, an indirect cost. It is a factory of it. So therefore, the production cost, the cost which are incurred in the production process, and they are classified into two. Now coming back to paper, when talk about the prime cost, so we need to make cost basically this is the total. The first one is the total of the direct revaluation cost. The total of the direct what? And basically, so if you take the direct material cost, the direct labor expense, remember you say plus any other direct expense, you get the prime cost. Then from there we have something known as so that's why we are told in the first paragraph, the work in progress one. So basically work in progress, abbreviated as WIP. This refers to those particular units which are or maybe to those finished goods which are partially complete at the end of the year. Like let's take a good example of a company which manufactures something like motor vehicles, or maybe a company which manufactures things like what motorbikes. Maybe there are those motor vehicles, there are those motorbikes which are partially complete when they are coming to an end. Partially complete means that something needs to be done to them before they can be taken to the market. They are not partially complete. They cannot be taken to the market. So we refer to those units as work in progress. Working what? As working progress. Then from here we have maybe another term, and basically that is something called the unrealized profit. Unrealized profit. So when we talk about the unrealized profit, generally most of the manufacturing companies may be having a policy of transferring the finished goods to the warehouse at a cost plus a certain profit. What does that mean? Generally, what we know is that if we have a manufacturing company or a manufacturing entity, this entity, once it has converted the raw materials into finished goods, so remember this now takes place in the factory. This one is so this conversion of raw materials into finished goods takes place in the factory. But this finished goods, are they kept in the warehouse? Because we say are they kept in the factory? No. So we need to usually they are transferred. We need to compute fair value to a warehouse. We need to compute the fair value to a warehouse, and basically this whereby now they can be sold. How do we compute that? This whereby the company can be able to do what? Go ahead and sell them. So most of the companies will be having a policy that whenever the goods we need to compute, whenever the goods are being transferred from the factory to the warehouse, they will be transferred at a cost plus a profit. At a cost plus a profit. For example, maybe you can be told the company transferring the goods at a cost. So you need to record the 10% which I gave you here. Profit. That is basically what you need to remember. This particular profit here, the revaluation. This one is always recognized as an income. Is always recognized as an income, and then in the income statement, or basically in the statement of profit or loss. But you can see the proportion of time here was based on the goods which were manufactured the number and transferred to the factory. So, and therefore, this particular profit can only be realized to the date of if all the goods now which will be transferred to the factory will have been sold. Will have been sold, because once a company transfers the goods now from the factory to the warehouse, and there is a profit which is computed on those goods, that profit can only be realized if all the goods will have been sold to this is the customers. But if some of the goods are not yet sold, and if you go to the requirement, you'll be able to see. Then when we have the aspect of what of the and it is what the year which now having known those particular terms, I want us to move and basically we look on how do we prepare now a manufacturing account. So that is the date which you have seen is basically prepare to determine the production cost for the manufacturing cost. 31st of March. It started on 1st of April. Manufacturing. So this year started on 1st of April. Account. So therefore, you can see our subsidiary here now was acquired. When preparing this account, the first thing we do was acquired basically to determine the price. So therefore, because remember, I've said that this production cost time we have here for this cost, which will be one in terms of producing some units, we classify that cost into direct and indirect. First of all, we compute the total direct cost. So we start by computing the cost of raw materials which were consumed. And I hope you can see that. So here we start with the opening. Can you see the remaining useful price? How many years? The opening inventory. Remaining useful price. In note one, how many years? Inventory of raw materials. Who can see that? Who can see that? Raw materials. 8 years. To this we add the remaining useful price of that the purchases. Can you see that? Of raw materials. 8 what? 8 the raw materials which were purchased. So we divide this, we add carriage, and then the proportion of time here we are saying is one carriage is 1 year. Inward. If for example in our case we had 6 months, I hope you can be able to remember we had 6 months. So then the proportion of time here is maybe a manufacturing company has bought some raw materials. If we had for example 2 years, cost in carriage. So that is carried inward. So and then to this we less proportion of time should be purchases should be what? To but in our case we interacted with these are raw materials which had been bought for how many years? Returned back to the suppliers 1 year due to a number of reasons. So this will give us, and then in this case we get the raw materials available. Now this 70 million raw materials, which items will be adjusted here? One, this one available deducted from the PPE when preparing our raw materials available for financial, and then out to this we less. Number two, the crossing we will also deduct this from the retained earnings of the which company inventory. Retained earnings of paper. Raw materials. And number three, so once we have deducted the consolidated inventory of raw materials, we get something called the cost or loss. This one will be the raw materials which were used will be adjusted or the cost of raw materials should be added to the cost of sales unless otherwise. So these are the raw materials which were consumed in note number one, basically which were used during that position of the during that payment year. So after getting that cost of raw materials, the cost of direct are we going to add this to the cost of sales? To this we proceed and we add other direct expenses like the direct this depreciation wages to what? The direct wages or maybe the direct to the administrative expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. The direct labor cost. This is something which you have to understand because in all maybe for group account, we also add any other concept. Direct expense. The subsidiary company example of the direct expense which are given in this particular question for the revaluation gain and the companies is something called royalty. Royalty basically is a cost that is incurred by the company or basically an amount that is paid by the company. If the company, for example, is extracting some raw materials, maybe from a land owned by another person, like maybe the raw materials used by the company, maybe something like in computation, maybe something like that. And who can tell us? So based on that information, or maybe that method are we going to use the computation of goodwill is harvested from maybe the land belonging to another person. So the company agree with the owner of going to use the land goodwill method. Maybe for each ton goodwill method, which method are we going to which is harvested on that land, the company will be paying a certain amount of money. That sand is a raw material, but now the amount which is paid by the company depends on the number of tons which are harvested. Is a direct cost. Automatically is a direct cost. So if you're given a royalty, the question for the manufacturing is a direct expense. That's why still in point number. So you add all this, and we the fair value of the non-controlling is now what we refer as the prime cost of paper limited. The prime cost. Remember we have said that the prime cost is the total of the direct computing work. So after getting the prime cost, we proceed. So now we add the factory overhead. Point number three. And the factory overhead. Remember, I've said factory overhead. In other terms, these are the indirect. The indirect production 560 million. Indirect production cost basically I've said that these are the production costs which are incurred by a manufacturing entity. This goods basically which was sold by the paper limited production. These costs are constant. This one we refer to whether the level of production changes or not will remain the same.
amount of
they remain the same. And just give good examples of this, like maybe the rent of in a factory building,
trading
of the factory
intra-group
building, rent of factory building.
And basically,
we also have maybe the depreciation of a factory building.
They had a value of
factory.
So basically, we have said that this building between the parent and the subsidiary.
So we also have maybe
so therefore, this one
of machinery
will be deducted from the group revenue.
Depreciation of machinery.
This one will be deducted
machinery
from the group revenue. And number two,
so those are basically good examples
from the group
of
cost of sales.
Indirect cost. Indirect cost
revenue
which are incurred in what? In the factory. So and then once you have gotten the total here, we proceed and we add
of these goods was still
something called the opening
as at the end of the
work
year,
in progress.
And the balance,
the opening work in progress,
payable,
and basically to this we less
still outstanding, and the balance payable was still
the closing
outstanding. Now in that case we have
two adjustments
here.
In
the first adjustment
the closing
is
work in
adjustment
progress,
for
the closing work in progress,
and also adjustment for
what do we get
of
after doing that? So we get now something called the cost of the goods which were produced.
We compute the amount of unreleased profit, amount of unreleased profit. So we get something called the cost of the goods produced, inventory,
the cost
on
of
inventory. Remember, unreleased profit we said arises whereby we have sales between the parent and subsidiary,
the cost of
and some of the goods were to the
produced. So in other terms, whatever we are getting here, this basically now the
point
cost
we are told
of the goods now which were
this
produced
company
by
which
the
is
company during that during that
our
year
subsidiary
is the cost of the goods
but
which were produced by the company
in the inventory
during that year. But remember, I'll say that most of the companies, most of the manufacturing companies will be having a policy that whenever the goods are transferred from the factory after they have
this one. So this is
manufactured
by
to the warehouse, they will be transferred as a profit element. So if a company has
how do we
policy,
compute?
you'll always be given that
this
information.
We take,
and therefore what you do, you compute something called the manufacturing profit.
The unsold goods,
the profit which is to be recognized by the factory, we refer to that as what?
Times the
manufacturing profit.
Margin. That is the formula you need to remember.
So in this case,
the formula
given as a percentage.
For computing
it should be a percentage of that.
And realize what?
So and then whatever you get here,
so let's
we refer to this as the transfer price.
The unreleased
transfer price. So why are we referring to this as the transfer price? Is because this is the price at which now the goods will be transferred from the factory to where?
At the end of
the warehouse.
After the warehouse, I've seen
this basically what happened in a manufacturing company. Once the goods have been manufactured in the factory, they are not kept there because automatically they cannot be sold from the factory. The factory, the work of the factory is basically to
multiply that with the gross profit
to convert raw materials into finished goods. Once they are converted, once they are finished, they'll be taken to the warehouse for them to be sold. So this is the transfer price, the transfer price. So basically this is now how we do what? How we prepare the manufacturing account, the manufacturing account. And basically after doing this now, I've said that a manufacturing entity then will still proceed and prepare the other final account.
As a fraction,
the statement of profit or loss,
as a fraction,
and the statement of financial,
it will be equal to what?
Is there any difference in terms of how we prepare these
as a
financial statement?
That one would be
of a manufacturing entity,
and then
what you have been doing,
we add there,
it will be one over difference. The only difference which exists,
so this one will be
a slight difference.
The margin
when comparing this, which I've already mentioned.
So how much will be our
when computing the cost of sales?
Here. So it will be
when computing the cost of sales,
and basically
here remember you must be able to appreciate what is sold by a manufacturing entity. A manufacturing entity sells the finished product. So therefore we compute the cost of sales based on the finished whatever a manufacturing entity sells. So we take the opening inventory.
That one will be deducted from the change earnings of paper, and then in preparation of the consolidated
and then for this we do what?
This one we have said should be added to the group.
In this case, remember I've said we don't have purchases,
the group cost of
but to this now we add
the three adjustments which will be made
the cost
as far as that of profit is concerned. So we are done with point number 3, but even before you move to point number 4,
produced
in the last part of that,
a manufacturing entity transfers those particular goods now to the
point number
the
3,
warehouse at
we are
a
told
transfer
the
price,
balance payable
that is
was
at
still
this cost
outstanding.
plus a profit.
The
So what
balance
we
payable
consider
was
here
still
is the
outstanding. What is
transfer
that?
price.
Balance payable was
Is
still
the transfer
outstanding.
price. I've said
What is that? Who can
it
tell us?
is not all companies which will be having a policy
Balance payable was
of
still
transferring the
outstanding.
goods from
Balance
the
payable
factory
was still
to the
outstanding.
warehouse at a cost plus the profit.
Basically, that is amount
So
of
if this one
debt.
we only
Now,
added,
if this
I
company
think
sells some goods
it
to
was
this,
important for me to note that
sells
if
some goods to
any,
this,
so if a
that
company
this
has a
company, the
policy
parent company,
of
should
transferring
pay
the goods from
should
the
pay
factory to the warehouse at a
subsidiary. But in
profit,
this case,
that's
we are
only
told,
when you add that here.
we are
But
told
if
the
the company does not have that policy,
the
in
balance
fact, that should be
payable
the end of year manufacturing
still
account.
what?
Your manufacturing
still,
account should end at
outstanding.
that point.
So how much
That's
will
why
be the
we are
balance
saying
which
here,
was payable?
if the company do not have this
The
policy,
balance
what we
payable.
consider here is this. If the goods
The
are
balance
transferred
payable
from
should
the
be what?
factory to the warehouse at a cost plus a profit element, what you consider here is the
balance payable
transfer price, this one.
Will be
Yes.
what?
So then to this, we basically get something called the goods available
The balance
for sale.
payable here will be 500.
And then out to this, we less
500 million. 500 million. That
the
is
cruising,
because the amount of money which
inventory
Limited was supposed to pay paper was 500 million. So this amount is the one which amount to
of the finished goods
or
goods. And basically in this case now, we will be able to get something called what? The cost of sales. I think that is the only difference which we have. And actually, after getting that cost,
so
of
in
sales,
this case,
less it to the sales or the revenue, we get the gross profit.
500.
We check whether we have
this
any
one
other income.
Will be deducted
we get
from the
total
group
income and we less the normal expenses.
And also it will be
so the expenses
from the group
which we include here
group
are
receivables and
the
group
other expenses. The other expenses
to
of
point
the
number
manufacturing
4.
entity other than
And
what
we
we have here.
Impairment
So the production cost, the costs which are incurred in the production process, will not go to the statement of profit or loss.
That both goodwill on acquisition
So actually, what the expenses which we include here
and the
are the
interest
administrative expenses,
administrative expenses,
and maybe
the
selling and
investment
distribution, because
the joint
you can see
venture
all
were not yet
manufacturing
impaired.
expenses.
So
all
no,
the
our
production
income is
costs are
required.
included.
Number 5, incomes and expenses
Yes.
of the group.
So that basically how we prepare the manufacturing
of the
account. And
companies
said
are
after
deemed to
preparing
have
the manufacturing account,
inventory
we then
throughout the
proceed
year.
and do
So
what?
that information
And
is
then
always given, such
prepare
that
the
if there
statement
is
of profit
something
or
you
loss
need to
and the
apportion on
statement of
time
financial
basis,
position
or
in the normal
something you
way.
need to
So this
apportion,
basically
you
where
apportion it on
we may
time
be having
basis.
a slight
You apportion it on time
difference.
And it
So I'll
can
be
come
able
in
to share the
charge.
notes on this maybe tomorrow.
There is something we need to compute before
tomorrow,
we proceed to prepare
maybe
what
someone
is
will
required.
be might
I want us to
leaning
compute the goodwill on acquisition
today,
because there is
yes,
something
maybe Benson you can
we will
remind me to
compute
share
here.
this tomorrow.
Then first of all, we compute the goodwill on
Peter.
acquisition of this.
Yes, when getting the cost of
company
sales, do we adjust?
Remember, you said we only compute the goodwill on acquisition of the subsidiary, and we recognize that as an asset within the consolidated statement of financial position. The goodwill on acquisition of joint venture, the goodwill on acquisition of the associate is not computed and recognized as an asset within what? The consolidated
trading
statement of financial position. So let's compute
automatically those in
the goodwill.
I've never seen a question whereby you're told there are some goods in transit. Goods in transit.
This company that is paper.
Goods in transit in relation to what? Basically, you see, whenever you sell goods, to your customers, you recognize that revenue as the revenue.
Number 2.
So therefore, whenever whether the goods are in transit to the customers or not, you have already sold the goods to them.
We recognize that as sales. Goodwill method.
We recognize that as what? As sales. How do we treat spares?
So here we need to have 2
spares,
columns.
Machinery spare parts. I think those.
And
in case maybe there was a spare part.
I hope you can be able to remember how we compute the goodwill.
You'll be given that information, but in most of the cases,
we start with the purchase consideration,
repair and maintenance. Repair and maintenance
paid by the parent company.
Repair and maintenance expense, which I think should then be part of the factory of
the purchase consideration paid by the parent company. This one is given within paragraph.
So I want us to go straight to a question now.
Let's go back to paragraph 1 and 2 of our question. So first of all, we go to paragraph 1. Actually, paragraph 2, not paragraph 1. Paragraph 2. We are told the acquisition consideration. This is the acquisition of the subsidiary. The acquisition consideration consisted of an immediate cash payment, of
So I want us to start with, I think, the latest question on this. So we go to the past papers. So let's go to the question for, is it December? Yes, I want us, we do a question, at least we will be able to finish. I don't know whether we will be able to, okay. So can we go to this question here for April 2024? I think the question has both, actually the manufacturing statement of profit or loss, statement of financial position. I think the question do not have so many additional information. It's a question we should be able to finish. April 2024. April 2024, which is the question number question number 3. Question number 3. Question number 3. Question number 3. So once you get the question, please confirm. Please confirm so that we move together. So if you're fair, yes, are you there? Are you there? Are you there? Eunice, Benson, Paul. Okay. Okay. So what are we told? What are we told here? The question is, the following trial balance was extracted from the books of 𝐎𝐍𝐿 Limited, a manufacturing company, is at 31st of this March 2024. So we're given the trial balance there, and basically we have so many items there. So maybe we have ordinary share capital, revenue reserve. Revenue reserve, if you're given revenue reserve, this is another name for retained earnings or the retained profit. So then from there we have bank, we have receivables, we have payables, factory buildings, and we are told land is part of that. We have plant and machinery, motor vehicle, furniture and fittings, accumulated depreciation basically for 4 assets there. We have inventory. I've said the manufacturing companies, they have 3 items of inventory: raw materials, work in progress, and the finished product. That is something already I've mentioned. We have around for doubtful debts, bad debt, rent, return and insurance, direct wages, salaries, factory power, electricity, maintenance. And then we have return outwards, we have return inwards, we have advertising expenses, transport expenses, bank charges, salary expenses, purchases, and sales. Then we have additional information, number 1, all the way to note number 5. We are going to go through that as we do some workings. So what are we required to do? We are required to prepare the manufacturing account for the year which ended 31st of March 2024, 6 months. And part B, we are required to prepare the statement of profit or loss for the year which ended 31st of March 2024. And finally, we are required to prepare the statement of financial position. So I want us to go through the additional information. We see, are there some workings we need to do? So in additional information number 1, let's go to the additional information number 1. We are told depreciation is provided using straight line basis as follows. If it is on straight line, depreciation will be computed based on cost. So we need to compute the depreciation for those, how many assets? 4 assets. So let's compute the depreciation. And basically we will start by computing depreciation on plant and machinery. So this one we are told will be 30% automatically of the cost. 30% of the cost So then the other asset, we have motor vehicles, and the depreciation will be 25% of the cost. We will take the cost from the trial balance, and then from there we have furniture and fittings, 12.5% automatically of the cost. And then finally we have buildings, and this one will be 4% of the cost. So what I want us to do, we go back to the trial balance, we pick the cost, we take the cost of these assets. So we'll start with the cost of plant and machinery. So where do we have the cost of plant and machinery? So plant and machinery, I can see that cost below where we have the factory buildings up there. I hope you can see that. Plant and machinery, the cost is 10,920. And then for the other asset, which is motor vehicle, the cost is 7112. The cost of furniture and fittings is 3400. And then what is the cost of building? So the cost of buildings is basically where we have the factory buildings, just above plant and machinery. And you can see we are told the factory building is 10.5. So, and then you're told included here, because I hope you can see inside the bracket, you're told included in this cost is the value for land, is the cost for land. So 10,500, this comprises the cost of land, comprises the cost of the factory building. So what we need to do is we compute what is the cost of the building. So the cost of buildings automatically will be the difference here, which will be 6,300. So 6,300. So we need to get now these particular depreciations. So give me the first depreciation for plant and machinery. We try to hurry up so that we finish this particular question here. We try to hurry up. Yes. So what are you getting as the depreciation for? Yes, I'm told 3276. 3276. Depreciation for motor vehicles. Depreciation for motor vehicles will be how much? Depreciation for motor vehicle will be 1778. That is the figure I'm getting from Evans. So please, we try to hurry up so that we finish this particular question. Furniture and fittings. 425. And then finally, buildings. 20 what? 252. Yes, 252. Okay, so we are done with that. And then you're told number 2, inventory as at 31st of March 2024 was valued as follows. So this is now the closing inventory. No working for that. We are given the closing inventory for raw material, work in progress, and the finished goods. No working for that. Number 3, we are told allowance for doubtful debts is provided at the rate of 10% of the trade receivables at the end of the year. So what we need to do here is basically we compute the allowance for doubtful debts, and basically we compare that with the amount which we have in the trial balance. So we are told this one will be 10% of the trade receivables. Trade receivables, basically, how much is that? So I hope you can see the trade receivables. Trade receivables are up there, the third item within the trial balance, the fourth item actually, which is 11,080. So this one will give us 11 what? 1108, or basically 110.8. Should be 110.8. What are you getting, Chris? Okay, sawa. So then what basically we need to do is we compare that with the allowance for doubtful debts which we have in the trial balance. So remember, this is the allowance for doubtful debts at the end. So we need to compare this with the allowance for doubtful debts at the start. The allowance for doubtful debts at the start is basically the amount we have in the trial balance. The amount we have in the trial balance is 588. 588. So in this case, I can see we have what? This to this. Nicole, you're saying is what? I hope the figure this one is correct. Is it correct? 1108, is it correct? Okay. So basically, I'm saying we compare this one, which is at the start, with this one. So that is an increase. From 588 to 1108 is an increase. An increase of what? An increase of what? We try to hurry up, guys, so that we finish this particular question. We can't afford to leave the question hanging. So that is 510. So remember, this particular increase in allowance for doubtful debts, this one we account for it as an expense in the statement of profit or loss. We are done with that. Then number 4, we are told electricity rates and insurance sundry expenses maintenance are to be apportioned in the ratio of 2:1 between factory and administration. So if you're told some expenses are to be apportioned, it basically means that some of the expenses belong to the factory, and any expense which relate to the factory, it should be included within the manufacturing account. It is basically one of the factory overhead. Is one of the factory what? Overhead. So all the factory overheads, all the factory expenses, we take them into account when preparing the manufacturing account. And then any administrative expense, because I've said when preparing the statement of profit or loss, we include what? We include the administration, the administrative expenses, and also the selling and distribution. Selling and distribution costs. So this one go to the statement of the profit and what? Loss. But I've said any factory overhead, or any factory expense, this one go to the manufacturing account. It's very, very important for you to know that. Yes. So therefore, what we will be able to do, for example, when preparing the manufacturing account, we will be able to compute those particular expenses to be apportioned to the factory. When preparing the statement of profit or loss, we will be able to compute the expenses to go there. So I think we will do that when preparing the respective accounts. So number 5, we are told manufactured goods are transferred to the warehouse at the total factory cost. So if you are given that information, goods will be transferred from the factory to the warehouse at factory cost. There is no manufacturing profit. There is no manufacturing what? Profit. And I think having that now, we can be able to proceed, and basically we prepare what is required in part A. We prepare what is required in part A. That is the manufacturing statement. Manufacturing statement. What is also known as the manufacturing account. You can just refer to it as manufacturing account. Yes, and this is for the year which ended 31st of March 2024. 31st of March 2024. So for you to be able to prepare this account, what is just required is just to remember the format. If you can be able to remember the format, then to prepare this one is very, very simple. So I want you to have that title because I want us to do this in less than 10 minutes, because now we have all the items, just the format we need to remember. Okay, so we go straight to this. Remember, in our case, we need to have basically how many columns? We need to have 2 columns here. 2 columns. And I hope you can see also our figures are in thousands of shillings. And in thousands of shillings. So here we start by taking the opening inventory. of what? The opening inventory of raw materials. So it is important for you to note that when preparing the manufacturing account, we first of all compute the cost of raw materials which were consumed. Yes. So what is the opening inventory of the raw materials? That one is within the trial balance. Within the trial balance below, where we have the accumulated depreciations, and the inventory, the opening inventory of raw materials is 2870. So to this, what do we need to add? We need to add purchases, and basically the purchases of raw materials. Where do we have the purchases of raw materials? The last item within the trial balance. The last item within the trial balance. We are given purchases and sales. So no need to think what is sales and what is purchases. Purchases is an expense. It should be on the debit column. So in other terms, those figures, they follow one another the way the words are arranged. Purchases come first, the sales should be on the other side. So the purchases of raw materials, therefore, is 77,000. So to this, then we have said we add the carriage inwards. And I think in this particular question, do we have carriage inwards? Do we have carriage inwards? Can you see carriage inwards somewhere? I can't see any carriage inwards. I can't see any carriage inwards. Any carriage inwards. I can't see any. Yes, and then now to this we less the return outwards, or basically the purchases return. The purchases return outwards, or basically the purchases return. Purchases return, and I think we have that. We have a return outwards. I hope you can see that figure down there, over 266. Anything to be deducted, we said, should always be inside there in the bracket. And then what we will be able to get here are the raw materials available for use. Raw materials available for what? For use. Give me that figure. We try to hurry up because of time. Raw materials available for use. Raw materials available for use. We try to hurry up, please, because of time. 79,604. Yes. And then out to this, what do? We less the closing inventory of the raw materials. Now, the closing inventory, this one is always part of the additional information. Part of the additional information number 2. In note number 2, we have the inventory at the end of the year of raw materials, and that one is given as 11,690. It is also important to note that our figures here are in thousands. When taking any figure from the additional information, we must omit the last 3 zeros. Yes, that's why you can see we are not taking the full amount. Then here we will get the cost of the raw materials which were consumed, or basically the cost of the raw materials which were used. So this will give us what? This will give us what? 67,914. Yes. So that is the cost of the raw materials which were consumed. And then I've said to this, we should proceed and we add the other direct cost, the other direct manufacturing cost. Things like maybe the direct labor cost, the direct wages. I think in our case, I saw direct wages. Yes, there is somewhere we're given the direct wages there. The direct wages. So we add it here. The direct wages, which is basically below the rent and insurance, and that is an amount of 6440. And then now to this, we should also add any other direct cost which is incurred in the factory, e.g. what? Royalties. E.g. royalties. And I think in our case, we don't have any other direct cost. Any other direct cost. I don't think so. I don't think we have any other direct cost. Other than what? Other than the direct wages. Okay, yes. So basically what we need to do, we need to get the total here, which now will be known as the prime cost. Prime cost. Prime cost is the total direct cost. Prime cost. And that will be what? That will be 74. 74.3. No, those are not direct expenses, Paul. They are indirect costs. They are indirect costs. Sasa, yes, that's basically what we are adding here. After that, factory power. This is not this is not a direct expense. So anytime there is a direct expense, will be given. Direct expenses include things like direct wages or even direct labor costs or royalty. Any other, like the one which I'm told there by Peter, factory power, that is basically indirect factory cost, or basically factory overheads. Yes. So what we need to do here is we proceed and we add the factory overheads. Make sure you write that in full, or the indirect cost. The indirect what? The indirect cost. The indirect cost. You see, something like factory power. Factory power is something like maybe electricity. So electricity, basically, we know is not 100% direct cost. So if the company is not producing, company will have to pay some electricity. Some of the electricity is fixed. That's is not a direct cost. So those costs which are pure direct are things like wages. You only engage workers to work in the factory. Whenever you are producing, you pay them based on the hours they have worked there. You only buy raw materials whenever you are producing. So all those are direct costs. But electricity you have to pay whether you're producing or not. Rent you have to pay whether you're producing or not. Your asset will have to depreciate whether you are producing or not. Those are indirect production costs. So the indirect or the factory overheads, which I want us to include here first of all, is maybe from note number 1. From note number 1, we need to ask here which asset here, which are used in the factory, because you need to know the asset. You can see the examiner, for example, he has not will not tell you which assets are used in the factory, which assets are used for administration. But basically, we know plant and machinery. Are these assets used in the factory or they are for administration? Tell me. F for factory, A for administration. Where do we use machines? Machines are used in the factory. Machines are used in what? In the factory. That's the position. Units, where do we use the machines? Machines equal factory, senior. So their depreciation will not be taught by the examiner as a factory overhead. So we have depreciation on plant and machinery. And maybe you can record those in the first column here. 3276. So what about motor vehicles? Motor vehicles, is there any information we are given about motor vehicles? So some of the assets you may be told by the examiner. Like in this case, you can be told a motor vehicle is a delivery van. So if it is a delivery van, it's basically for delivering goods to customers. So that depreciation should be a selling and distribution. But in this case, you can see, take into account the question is silent. In this case, we will treat that as administration expense. So we treat it as administration expense, because we know a motor vehicle will not be used in the factory. We use a motor vehicle within the factory unless maybe you're told there are those tractors for off-roading and maybe roading. Yes, but in this case, you're given a motor vehicle. The question is silent. Treat that as part of what? as part of selling and distribution. So then we also have furniture and fittings. Furniture and fittings, they are not used in the factory. They are used in the office. But now this factory, this building, if you can be able to recall, we are told is a factory building. Factory building, these are factory buildings. So its depreciation should be part of the factory overheads. Depreciation on factory building, this one, which is 252. Yes, then we are in the additional information. I want us to go to note number 4. In note number 4, we are told there are those particular expenses which are to be shared. Basically, to apportion an expense is to share. There are those expenses which will be shared between administration, between the office and factory. One of it is electricity. The other one is the rates and insurance. And also we have the salary expenses. Salary expenses and basically maintenance. So we take these particular expenses and basically we take the amount to be apportioned to factory, the amount to be shared by factory. So let's, first of all, we take the expenses. But even before we take the expenses, we are told that these particular expenses will be apportioned or will be apportioned in the ratio of 2:1, between factory and administration. So the factory here will get a share of 2 out of the total, out of 3. So that is the factory share. 2 all over 3 times the expense. 2 all over 3 times the expense. 2 all over 3 times what? The expense. So let's now take the expenses. We will start with electricity, which is within the trial balance. And I think I can see that below factory power. That is 1386. And then we have rates and insurance, which is 798. And then we have salary expenses. Salary expenses, where do we have this? So we have this as the second item from the bottom of the trial balance, 2436. And then we have maintenance. Maintenance is below electricity, which is 924. So let's work out these figures. So we start with electricity. We get 2/3 of 1386. Yes, so get 2/3. Okay. Yes, I think I have a calculator here. 2/3, I'm told by Paul, is 924. 924, please confirm that. The other one I'm getting 532. 532. The other one 2 all over 3 times 24, 36, which is the 1624. And then the other one is 924 times 2 divided by 3, which is 616. 616. I hope that is what you're getting. Yes. So we are done with that. So we need to move to, yes, I think basically we are done with the additional information. So what we need to do is we go back to the trial balance. We pick now the other expenses which are factory related expense. Factory related expense. Maybe you can start from the last item within the trial balance. We have purchases. Is not an expense. We have dealt with salary expenses. Bank charges is not a factory related expense. This is administrative expense. Transport, this basically transport expenses is also administrative, or maybe selling and distribution. It cannot be a factory, because factory we can only have carriage inwards of raw materials, which you already considered up there. Advertising is a selling and distribution. You advertise in order to sell. This is not a factory expense. Return inwards, that one will be deducted from the sales Return outwards, we have dealt with that. Maintenance, we have dealt with that here. Electricity, we have dealt with that. And then we have the factory power. Factory power is basically a factory overhead. A factory power, which is 1890. And then above that, we have salaries. Salaries, were these to be apportioned? No. So, but in this case, salaries, if the question is identity is administration, because in factory, what is paid are wages. Wages are like salaries, but wages are paid based on the time you work. Sasa, yes. So then above that, we have direct wages. We have dealt with that. Rent and rent and insurance. We have dealt with that. Budget. This is a selling and distribution. So, and then we have allowance, which is still a selling and distribution. Then we have inventory accumulated. After, I think we have the asset only. So we don't have any other expense here or any other factory overheads. So what we need to do is we basically get the total and we take that now to the last column. So let's get the total here. 3276 plus 252 plus 924 plus 532 plus 1624 plus 616 plus 1890. So I'm getting a figure of 9114. Confirm whether that is the figure you're getting. Yes. So we added to this. We added to that. That is 74,354. And I'm getting 468. So confirm whether that is the figure you're getting. Confirm whether that is the figure you're getting. Is that the figure you're getting? Okay, sawa. So then to this, we have said we proceed and basically we do what? We add opening work in progress. We add opening work in progress. Opening work in progress. So we add this and basically we less the closing work in progress. Yes. So, and in our case, we have this work in progress. The opening work in progress is within the trial balance. So can we go back to the trial balance? The opening work in progress is given as 4830. And then the closing work in progress is given within note number 2. Within note number 2 is given as 6930. So, and then now to this, we will get the cost of the goods produced. The cost of goods produced. Cost of goods produced. So give me the final figure here. So we take this one, we add 4830 minus 6930. Yes, so basically that's the figure I'm getting. I don't know whether that is the same figure you're getting. Yes. Basically, that is it. That's what is required as far as the preparation of the manufacturing account is concerned. And the marks are located there were 6. Automatically, these are the items which are marked here. These are the items which are marked. And basically, by doing that, you get 6 marks. So let's move to part B. And basically, we are required to prepare the statement of profit or what? Or loss. basically for the year which ended 31st of March 2024. 31st of March 2024. Basically, I've said there is not much difference in terms of how we prepare this. So to prepare the statement of profit or loss, it's all depending whether this business is a company, whether it is a partnership, whether it is a sole proprietorship, because it is also important for you to note that a manufacturing business may be conducted as a company, may be conducted as partnership, may be conducted as what? Sole proprietorship. But I think this is a company. So this being a company, I don't think we have much challenge in terms of how we prepare this. So we will start with the sales. But remember here, we need to have two columns. We need to have two columns. I hope you can be able to see that far ahead. Yes. So we start with the sales. And basically sales is given as the last item within the trial balance. Sales as an amount of 103,600. Sales should be on the credit side of the trial balance because it's an income. So to this we less the return inwards. The return inwards. So the return inwards, I can see that within the trial balance, there's a figure of 84. So we less it there. And basically we get the net sales. We get the figure for net sales. Net sales will be how much? Net sales will be how much? Will be 103. 103, 5 what? 516, yes. So then to this we proceed, we compute the cost of sales. So the cost of sales, we start with the opening inventory of what? Of the finished goods. So it is important to note that here we use the finished goods. You can write that in full for your revision purpose. Opening inventory of finished goods. So we have this within the trial balance, the opening inventory of finished goods, which is given as 91. And then I've said that here we don't add purchases because generally we have been, all through we have been adding purchases. So here we don't add purchases. We have said manufacturing companies sell what they produce. They don't buy to sell. They produce to sell. So what we add here is the cost of the goods which were produced. The cost of the goods which were produced. So this is the cost of the goods which were produced. 81,368. That is now what they produced. And equally in this case here, we don't have return inwards. We don't have carriage inwards. So, and that's what you can see. Anytime you're given carriage inwards, you're given a return outward. The examiner will not even tell you that is carriage inwards or the return inwards for what, but automatically that is carriage inwards, return outwards for raw materials. That's for raw materials. Because what we sell here is what we produce. We can't have a return inwards of whatever you produce. We can't have carriage inwards for whatever we produce. So we add these two figures and we get the goods available for sale. And then to this we less the closing inventory still of what? Finished goods. Still of finished goods. So first of all, give me the goods available for sale. The goods available for sale. We add these two values. So this will give us 468 and then 0, 90, 468. Then we less the closing inventory. The closing inventory of finished goods, this one is given in note number 2. In note number 2, 8680. 8680. So you're getting what? Is the goods available for sale? 81,788. What are you getting? I'm waiting for the answer here. Yes, so we now get the gross profit. I think that figure is confirmed. I hope the figure I'm given by Evans is the gross profit, 21, 21,728. 21,7, okay, yes, thank you. So then to this, what do? We check whether we have any other income. Remember, I've said there is no difference in terms of how we prepare this one. So the only difference is here. Sasa, but the other parts are the same with what you have been doing. So what we need to do is basically we go back to the trial balance, and on the credit side, we check whether we have any other income like investment income, discount received, and so on. I think the items on the credit side up there, I can see ordinary share capital, revenue reserve. Revenue reserve, I've said, is another name for retained earnings. Never make a mistake of treating that as what? As an income. Down here, I can see we have payables, accumulated depreciations, allowance. I'm checking the items on the credit side and then return outwards. And then we have sales down there. So it basically means that in our case, we don't have any other income. So what we need to do is basically we proceed and we less now the expenses. We less the expenses. Now for the expenses, we can start with the additional information. Let's start with the additional information. We will start with the additional information number 1, where we computed the depreciation. And I think we said that this will be a factory of it. Any expense which you have included here, don't take it to the statement of profit or loss. Any expense included here is a factory expense. What we take here, I think I've already mentioned some, are selling and distribution and the administrative expenses. Sasa, yes. So this one you have already recorded here is a factory of it. Then we have this depreciation on motor vehicle. Depreciation of motor vehicles, which is 1778. Then we also have this depreciation on furniture and fittings, which is 425. Remember, this one is a factory overhead. So we are done with that. So then from there we have note number 2. We have that is all about the crossing inventory. Note number 3, we have the allowance for doubtful debts, and basically we determine the increase here. So this one is supposed to be included here. Increase in allowance for doubtful debts, which is 520, like that. So then from there we have note number 4. Note number 4, we have these particular expenses which were to be apportioned. These ones. So remember, the factory is getting a share of 2/3. So administration will get a share of a third. We'll get a share of a third. So I think basically we can take what we have here. We start with electricity. Administration, we will take a third of this, 1386. I hope you can be able to see down there. Okay, so we need to create some space up here. So we can do away with this. So we can create a space here. I hope you already have this with you. Let me do away with this one. Okay. So we have electricity, we have rates and insurance. Rates and insurance, which is basically a third of what? A third of 798. And then we have salary expenses. Salary expenses, we take a third of this, 24, 36. And then we have the maintenance. Maintenance, basically a third of this one, 920. 4. So let's compute those final figures. We start with electricity. We just take 1386 divided by 3, which will give us 462. And then we have rates on insurance. We have 798 divided by 3, which is 266. And then we have salary expenses, 24, that is 6, divided by 3, which is 812. And then maintenance, we have 924 divided by 3, which is 3 what? 308. I hope those are the figures you're getting. Are you getting those figures? Are you getting those figures? If yes, please confirm. Okay, that is confirmed by Evans. So we are done with the note number 4 and equal note number 5. So what we need to do is basically go back to the trial balance. We see we've dealt with all the selling and distribution and also the administrative expenses. Yes. So what we have there in note number, okay, the first, maybe you can start from the last item within the trial balance. We have purchases and sales. We have dealt with that. Salary expenses, we have dealt with that. We have dealt with the, okay, we have bank charges now. The bank charges. So bank charges basically is an amount of 238. So then above that, we have transport expenses, which we said is also supposed to be considered here. Transport expenses. Transport expenses, 1946. Then we also have advertising. Advertising expenses, 728. Then we have the return. After we have maintenance, electricity, we have dealt with that. Then we have factory power. We dealt with that as a factory overheads. And then I think we also have salaries. Have we considered that here? No. Salaries. So basically salaries is an amount of 7560. 7560. We have direct wages, which is was part of the prime cost. Rent and maintenance, we have dealt with that. And then we have the bad debts. The bad debts, basically, which amount to 406. So up there we have inventory. Yes, and I think basically we are done. We don't have any other expense. So what we need to do is we get the total expenses. So let's get the total expenses here. Starting from where we have the depreciation of motor vehicle, 1778 plus 425 plus 520 plus 1520 plus 462 plus 266 plus 812 plus 308 plus 238 plus 1946 plus 728 plus 7560 plus 406. So basically I'm getting 16,969. So can you confirm whether you're getting that value? Are you getting that value? Are you getting that value? I'm waiting for the confirmation. If you're getting a different value, type it there. If you have a different value, if you have a different value, type it there. Eunice is getting a different value. 1549, 15. Okay, so it basically means that my figure is wrong. So then we should work with that one. 154449. Okay, yes. So we less that now from this one. And basically we get what? We get the profit before tax. Remember, this is basically a company. The profit before tax will be how much? 21,728 minus 15,449. So which is 62.79. 62.79. Okay. So then to this we should less the corporation tax. The corporation tax. And I think if you check on this particular question, we are not given tax. So if you're not given tax, we ignore that. So if the question is silent about tax, just ignore that. And then whatever you get here should be the profit for the year, because equally we don't even have anything to do with the dividends. So to this profit for the year, would we add? To this we add the retained profit balance brought down. The retained profit balance brought down, this, remember, is what you're given in the trial balance as the second item, and basically known as the revenue reserve. I've said if you're given revenue reserve, that is another name for retained profit or the retained what? Earnings, which is 10,150. And basically we are done with that. We get the retained profit balance carried down, which now would be 9,2,4,16. And basically remember, this is the value which we take to the statement of financial position as a component of equity. So we are done. We are done with that. So the marks allocated there were 8. Automatically, those are the items which will be marked here. These are the items which are marked there, which are marked. And basically, by getting that, you get how many marks were there? Are they? How many were they? There were 8. There were 8. So then I want us to finalize by preparing what is required in part C, the statement of financial position. Statement of financial position is at 31st of March 2024. 31st of March 2024. Yes, so here we just need to have a single column. And we will start with the non-current assets. We will start by recording the non-current assets. So basically we have a number of non-current assets. So let's start with which non-current asset. We start with the factory buildings. We start with the factory buildings. So what we will do, we will take the cost, and we will take the cost of 10.5, which include the cost of land. Don't separate that. So factory building, this cost comprises the cost of land. Now to this we said we should less 2 depreciations. Depreciation at the start and the depreciation for the current year. Depreciation at the start is what you're given within the trial balance. Within the trial balance, I hope you can see the accumulated depreciation at the start, 1250. And then to this, we also less the depreciation for the current year, this one, 276. So we will come back and basically compute this one. And then we need, below that we have what? We have plant and machinery. Plant and machinery, we do the same. We take the cost at the start. The cost at the start, which is basically 920 minus accumulated depreciation at the start, which is basically within the trial balance, and that is 2562. And then the depreciation, is that correct? Plant and machinery, the cost is 10,920. Accumulated depreciation at the start is not this one. This one should be 39,58. 39,58. And then we less the depreciation for the current year. Sorry. Even this one is correct, is not correct. The depreciation for building for the current is this one, 252. 252, Yes. Then plant and machinery, the accumulated depreciation at the start, I've said, is 39,58. And for the current year is this one, 32,78. 32,78. Yes. So then from there, we have the other asset, which is basically motor vehicle. Motor vehicle, I will take the cost, which is basically 71,12. I will less the accumulated depreciation at the start, which is within the trial balance, and that is 25,62. 25,62, and then the depreciation for the current year, 17,78. So then we also have the furniture and fittings, the cost, 34. The accumulated depreciation at the start within the trial balance is 25,62. Oops, no, is what? Is 980. And then the depreciation for the current year, which is 425. 425. I hope all those figures are correct. So what I want us to do is basically we compute the net book values at the end. So let's start with the factory building. Or is there anyone who has managed to compute those values? Maybe you can give me for factory building. So if you have managed to compute those figures, type them. Type them there. Okay, so I'm giving those figures by Evans. Yes, like that. Like that. No need of computing them so that we save time. Yes. So after this, basically we need to check whether we have any other an item of non-current assets. And I don't think we have. I don't think we have any other item of non-current assets. So I think we can move now and we record a current asset. So let's move and record current assets. So current assets. So for the current asset, basically we have a number of them. We have a number of item of current assets. So maybe starting from where we have, and remember all assets have a debit balance. We check the items appearing on the debit side. So the first item is the bank. The bank is 85,92. Then below that, I can see we have the trade receivables. Trade receivables, we will take 11,080. And then remember to this, we have around for doubtful debts at the end of the year, this one, which should also be deducted here. Which should also be deducted here. Maybe you can just give me the final figures here. The final figure, give me the final figure here. The final figure is 99,72. 99,72. 99,72. Is that what you're getting? Is that what you're getting? Okay. So then we still check the other whether we have any other item of current assets on the debit column. So down there, you can see we have opening inventories. So we don't record opening inventories here. Then you can see we have bad debt rate, direct salaries. I think all those are items of expenses, actually up to the last item. But now in the additional information number 2, we have the closing inventory. Additional information number 2. So the closing inventory, have closing inventory for raw materials, closing inventory for work in progress, and closing inventory for finished goods. So I've said manufacturing companies have three, or basically inventory comprises of 3 items. These 3 items. So raw materials 11,690, and then we have that is 11,690, then 6930, and then 86 what? 8680. So then we are done with the point number 3, 4, 5. Yes. So in our case, I don't think we have any other item of current asset. So what we need to do is to get the total assets. Give me the total assets. So add all those values. So if you have the total, type it here. Yes, what are you getting? Yes. So next we proceed, and basically we record equity. Equity. So equity comprises of the share capital and reserves. Equity comprises of the share capital and reserves. Share capital and reserves. So we start with the first item within the trial balance, which is basically ordinary share capital. Share capital. So the ordinary share capital is 42,000. So then from there we have the revenue reserve. The revenue reserve, I've said, that is another name for retained earnings, or basically the retained profit. And basically that is the revenue reserve at the start. The retained earnings at the start. Is that what we record here? No, whatever we record here is this one. The retained profit at the end of the year, which is 16,429. Then I don't think we have any other component of equity. You can check the items of the credit side, which we don't have any other item of equity. So we just get the total equity. The total equity, which will be 429, and then this one will be 58. Then from there we proceed, we record liabilities. We start with the non-current liabilities. Now for the non-current liabilities, in case of a company, we say that this may take the form of a bank loan, may take the form of debentures. So in this case, we don't have debentures, we don't have a bank loan. Sasa? Yes, my camera is almost going off. We need to finish on this. And finally, we need to record what? The current liabilities. So current liabilities, we check the items on the credit side of the trial balance. The items on the credit side of the trial balance. Other than what we have up there, share capital and reserves, you can see we have trade payables. We have the trade payables. The trade payables is an amount of 48,86. Then down there, you can see we have accumulated depreciations. And then down there, you can see we have allowance for doubtful debts, and then allowance. And then in the additional information, we don't have any item of current liability. So I think we are done. We are done. We are done. So we get the total equity and what? Liabilities. So you add these two. You add those two. They should give us 63,315. 63,315. Is that what you're getting? Is that what you're getting? Please confirm my camera is almost going off here. Yes, I'm told 63, 3, 1, 5. So basically that is it, that what was required. And basically by doing that, the marks allocated here were 6. The marks allocated there were 6. So basically what you'll do, you'll attempt another question, because there are so many questions from the past papers on this. And then once we are done with the syllabus, we will be able to come back to this topic, and maybe you do another one question or maybe two in course of our revision. Once we meet in our next class, we basically move to another topic. I think there is a topic which is remaining on manufacturing. Not manufacturing, accounting for non-profit making organizations. I think that should be the main topic, and then another topic for else. And then now other small topics, So we're almost done now. We're almost done with the syllabus. Right now, I can say we're almost like, can I say over 90%, over 90 or basically over 95% done with the syllabus. I think we should be at that stage of completion. So we continue from there in our next class. But I've said, go through those particular past papers, we'll be able to see that there are so many questions coming from this topic. Sasa, we stop at that point for now. Have a good night. We continue from there in our next session. Have a good night.
basically undertakes to compensate the insured on the happening of a contingency, or basically on the happening of a future uncertain event. And now the insured on his part basically commit himself to be paying some periodical payments, which are known as what? The premiums, which are known as what? The premiums. So therefore, it's a contract between two parties, the insurance company or the insurer, and the insurance company undertakes to compensate the insured on the happening of a future uncertain event, and this person on his part must be paying some periodical payments, which are known as what? The premiums. Now, these insurance companies usually provide various types of insurance businesses, and those insurance businesses are usually classified into two. So mean that we have two types of insurance business. Majorly we have two, or they are classified into two. We have the life insurance, and when we talk about the life insurance, this is a type of an insurance contract whereby the insurance company basically undertakes to compensate, or basically to pay the insured a certain amount of money, which is known as a lump sum, upon the insured attaining a certain age, or basically upon his death, whichever occurs earlier. So in this case now, a lump sum will have to be paid to the insured either upon attaining a certain age, or basically upon his death, whichever will occur earlier. Then from there we have now the general insurance. So when we talk about the general insurance, this refers to any other insurance business other than the life insurance, insurance or the life assurance. And therefore, the general insurance, this includes insurance businesses such as burglary insurance. You have a business, you insure your business against theft. We have the fire insurance, we have the motor vehicle insurance, we have the marine insurance, and so on. So all those types of insurance business, they fall under what we call the general what? The general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. Number two, we have the general statement of a profit or loss, or basically the income statement. And number three, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. The revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business. Assuming we have an insurance company which is maybe providing two insurance business, the life insurance and maybe the fire insurance. So those are two different insurance business. So the insurance company would like to know at the end of each year, how is each insurance business performing? So such an insurance company will prepare something called the revenue account. So therefore, this is basically prepared. This one is prepared to do what? To determine the financial performance of each insurance business. Business. So how do we prepare this particular account here? I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format, not the T format. So the revenue account. So assuming our insurance company basically undertake to insurance business, maybe like the fire insurance, or the provide to insurance business, the fire insurance, and maybe the life insurance. So basically in that case, we have two columns here. And when preparing this, always we start with the incomes, or basically the revenue from each insurance business, business. So the first, or basically what we know is that once you have insured a certain subject matter, you have to pay something called a premium to your insurance company. So this premium is one main source of income as far as these insurance businesses are concerned, the net premium. But in this case, we are going to look on how do we compute this. Maybe we will have working one. Working one, basically we look on how do we compute the net premium, because that is something which the examiner will not have given you. You have to compute that. And then now to this, and basically what we know is that if, for example, you have insured a certain subject matter, you pay the premium in advance. You pay the premium in advance. For example, you own a car, you have insured your car, you pay the premium in advance. Some insurance companies may tell you, can you pay this in 2 installments? So, but you pay the premium in advance. So, therefore, we know that that premium which you have paid basically covers or basically the insurance cover for the next 1 year. For the next what? 1 year. So basically, much of the money collected by the insurance company or much of the revenue is received in what? In advance. Now, this premium is only supposed to be recognized as an income by the insurance company once the period covered has expired. For example, if the insurance company has received premium of 1 billion, it covers the next 2 years. So that premium will only be deemed to have to be earned as an income once the 2 years are over, or basically 1 year is what is over. So therefore, you may see that out of these particular premiums which were received during the current year, you may be told that part of it was not yet earned because the period covered has not done what? Expired. So what do we do to this particular net premium? We basically add the unearned premium and earned premium balance brought down. So these are the premiums which were not yet earned in the previous year because the period covered was not expired. Automatically, the period covered by those premiums will expire during the current year because usually the premium you pay is for 1 year. So any premium which was not yet earned in the previous year because the period covered had not expired will be earned during this year. So therefore, these are the unearned premium from the previous year. And then to this we less the unearned premium, balance carried down, balance carried down. So these are basically the premiums which were received during the current year. These premiums which were received during the current year, but because the period covered has not expired, they have not yet been earned. So they should be deducted from this. And then now to this, we add something known as the commission on reinsurance, ceded. Also, I'll be able to explain something to do with that. Let's just put it as a note there. Yes, I'll be able to give a note for that. I'll also be able to give a note for that. So, and then we get the total here. We proceed and we less now the expenses. And the expenses which we less here are basically the expenses specifically relating to its insurance business because they are general expenses. The general expenses to the insurance company, we take them here to the general income statement. But basically what we record here are the specific expenses relating to each insurance business. For example, in this case, you may be given some legal costs associated with each insurance business. We may also be given budgets which were written off. Budgets written off, these are maybe the premiums which the customers decline to pay. We may also be given the management fee for each insurance business. We also have something called the net claims. In fact, this is basically the main expense for each insurance business. So once we have various individuals who have insured their subject matter with the insurance companies. So, and maybe the event insured against have occurred, they go to the insurance company, they release a claim. You have insured your car, you have taken a comprehensive insurance cover, your car is involved in an accident, you raise a claim with the insurance company. So once you are paid by insurance company, that is an expense relating to that insurance business. So we are going to look on how we compute this. We will have a note on that, note 3, yes. So, and then also there is something else here we should not forget, known as commission on reinsurance accepted. Commission on reinsurance accepted. I'll also be able to give a note for that. What we mean by that? Yes. And basically we less all those particular expenses from our total revenue here, our total revenue there. and basically we get something called the net income. The net income from each insurance business. The net income is basically like the profit from each insurance business. So this is basically how we prepare the revenue account for each insurance business, for each insurance business. So I think before you look on how we prepare the general income statement, maybe I can just give explain some of these items, like one, the net premium. So how do we compute the net premium? Which will be taken to the revenue account? So we can say this is basically computed by preparing premium account. Remember, premium is basically what you pay as a person who has taken an insurance cover. So to the insurance company, this is the amount they receive. So how do we prepare this account, the premium account? So, and also assuming our insurance business is providing to insurance business, is involved into insurance business, that is basically fire and life insurance. Fire and life, we have two columns on both the debit and the credit side, the fire and life insurance. So in most of the cases, you'll be told that some of the customers or some of the clients have not paid their premium. So if you have not paid your premium to an insurance company, you have not cleared your premium to the insurance company is an asset. So therefore, you'll be given the premiums outstanding at the start, which basically we record here as an asset. The premiums which were outstanding at the end of the year, simply because it's an asset. Premium which you have not paid is basically an asset. Then you will also be given the premiums which were received. So an insurance company can receive premium either from the client directly, from the stockbrokers, and so on. So therefore, the premiums which were received, the double entry, we follow the double entry, is debited in the bank and then credited in this account. So the premium which was received, and this premium can be received either from the clients, from the insurance brokers, brokers. Then on this side still we have the reinsurance premiums which were received, received. On this side, we have the reinsurance premiums which were paid. So this is basically whereby I hope you know what is basically to reinsure. So assuming we have a certain insurance company A, this insurance company A, which has got a number of clients, this particular client have insured a number of subject matter with it, but this insurance company may feel that the risk insured with it are too much. If maybe something happened, it may not be able to pay. So this insurance company may make a decision, can we reinsure some of this risk with another insurance company? So insurance company B, maybe something like that. So this insurance company will be paying something called the insurance premium. And then this one can receive reinsurance premium from another insurance company. So this reinsurance premium paid, the double entry, we debit this account, we credit back. And then from there, what we do, we basically balance this account. The balancing figure, which is on this side, is the net claims. And the net claims is basically now what we recognize there. So that basically how we compute the net premium, So then the other note we need to discuss here is on this one. The commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance ceded. Commission on reinsurance. Oh, sorry. So sorry. This one should be net premium, not net claims. Thank you, Mike. Thank you, Mike. Yes, so that one should be the net premium, not the net claims, Thank you for that. Yes. Now, in this case here, what is the commission on the insurance ceded? So first of all, to cede ground is basically whereby you accept that as an insurance company, the risk insured with you are too much. If all the claims are raised by your customers, you'll not be able to pay them. So you have ceded the ground. So therefore, what you do, you reinsure those particular sum of the risk with another insurance company. With another insurance company. So assuming we have insurance company A, this company may feel that the risk insured with it are too much. So it decides to do what? To reinsure some of them with the insurance company B. With the insurance company B. It is obvious that this company here will pay something called the reinsurance premium. So this company A, will pay something called the reinsurance premium. So this particular reinsurance premium, we said to the insurance company A, they are reinsurance premiums which have been paid. It is obvious that this company here, that is insurance company A, is giving insurance company B some insurance business. Some business. It's then fair for this company to pay some commission. So if I give you some business, some insurance business, you must give something in return, which is called a commission. So therefore, the commission which will be paid by this insurance company, and basically which is paid to our insurance company A, to this company we say it is a commission on reinsurance ceded. It's the commission on reinsurance ceded. To this insurance company is an income. Is what? Is an income. So therefore, we can say this number one is an income, and number two, we can say it is computed. It is computed based on the reinsurance, premiums which are paid. So the reason why it is important for you to note that is because in most of these particular questions, you'll be told that the commission on the insurance ceded is 5%. 5% of which the examiner will not tell you. 5% of the reinsurance premiums which were paid. So if this company pay premiums, reinsurance premium of 2 million, there may be an agreement that this company will be paying a commission of 2%. 2%. So it should be 2% of the reinsurance premiums which were paid. Yes. So then from there, we can look on the other item here, the net claims. How do we compute the net claims? So the net claims, basically these ones are computed by preparing the claims account. The net claims. So in this case, we have to prepare the claims account. So remember, claims, this is what now the customers, the clients of the insurance company want to be paid. Want to be what? To be paid. You have insured a certain subject matter, and maybe because the event insured against has occurred, you have raised a claim with the insurance company. So this one we have said to an insurance company is basically what? Is an expense. So equally in this case, we prepare this for each insurance business, assuming we have fire and we have rise. We have fire and we have rise. So in most of the cases, we'll be told, number one, there were some premiums, not premiums, sorry. There were some claims which were not yet paid by the insurance company. So the premiums not yet paid by the insurance company, this is the liability. So being a liability, the claims outstanding being a liability, that one will be the opening balance with this account on the which side? On the credit side. So the claims outstanding at the start, the claims outstanding at the end. at the end. What else do we record in this particular account here? The other item which we record here are basically the claims which were paid. You'll also be given the claims which were paid. The claims which were paid. So the claims which were paid, basically the double entry for that is what? The double entry for that would be to debit this account with credit bank. With credit bank. That is basically the double entry for that. Then the other item you may be given is what? Are the expenses relating to the claims. Expenses relating to the claims. Expenses which relate to the claims. And basically the expenses relating to the claims, those ones, they should be debited here. Those ones should be debited in this account. What is the double entry for those expenses? Because they were paid, we credit them in the bank, we debit them here. And then from here we do what? We balance this account, and the balancing figure, which will be on this side, is basically now what we recognize as an expense, what we recognize as an expense in the revenue account. In the revenue what? Account. In the revenue account. So that's basically how we compute the net claims. We compute the net claims. So the other item maybe I need to explain here, number 4, is the commission on reinsurance. On reinsurance accepted. The commission on reinsurance accepted. Commission on reinsurance accepted. So commission on reinsurance accepted. So when talk about reinsurance accepted, this we are assuming we are preparing this financial statement for insurance company A. This insurance company here may have accepted to reinsure certain risk or to reinsure certain risk of a certain insurance company, assuming we have insurance company C, and this insurance company has reinsured some of the risk with our insurance company A. So we say that is reinsurance accepted. So this company here will pay to our insurance company something called the reinsurance premium. But basically to our insurance company here, this will be reinsurance premiums which were received. So to our insurance company A, that will be reinsurance premiums which were received. It is obvious that because our insurance company has been given some insurance business, it must pay a commission. So this is basically a commission which is paid to our insurance company. So once our insurance company pay a commission, automatically that is an expense. So this commission on reinsurance accepted, one, this is an expense. This is what? Is an expense. And number 2, this one is computed. This one is computed based on the reinsurance premiums, which were received. Reinsurance premiums which were received. Because in an exam, what the examiner will tell you is that the commission on reinsurance accepted is maybe 2%, 5%, but he'll not tell you it is 2% or 5% of what. So it's basically upon you to do what? To know that this one is computed based on the reinsurance premiums which were received. So I think basically that's what you need to know as far as the preparation of the revenue account is concerned, specifically computation of net premium, net claims, the commission on reinsurance accepted, the commission on reinsurance what? Ceded. Basically, that's how we do what? How we compute those items. Then, after preparing the revenue account, we have determined the performance of each insurance business. Then from there, we prepare a general income statement, or basically a general statement of what? Profit or loss. Now, this one, as the name suggests, is basically prepared to do what? to determine the performance of the entire insurance business. This one is not prepared to determine the performance of each insurance business, but this one is prepared to do what? To determine the performance of the entire insurance business. So we can say this is the prepared. This is the prepared to do what? To determine a performance for the insurance company. The performance of the insurance what? The performance of the insurance company. The performance of the insurance what? A company. So how do we prepare this? Quite simple. Quite simple. We take all the incomes of the insurance company, and one income of the insurance company will be the net income which was generated from individual insurance business. So we take into account those incomes. We add them, the net income from individual insurance business. We add any other income by the insurance company, like an investment income and so on. And then we less now the general expenses. General expenses are those particular expenses not relating to the individual insurance business, not relating to fire, not relating to maybe life insurance. And then from there, insurance companies also prepare the statement of financial position. So statement of financial position, we know this one is prepared to ascertain the financial position of an insurance company. We prepare this in the normal way. We take assets, which we classify into two, non-current and current. We record equity, and then the liabilities, and then the liabilities. So the preparation of this is just the same with the preparation of the statement of financial position for other what? For other insurance. For other companies, for other what? Companies. So I want us to do a question, and basically we're going to borrow a question from FAR. So remember this topic previously it was in FAR, just like what I said in relation to the topic of banks. So this topic was previously examined in FAR, CP intermediate level, but basically it was taken to AFR, Advanced Financial Reporting. So we will definitely borrow a question from that. And I want someone to go to the link for, I know you have the link for the past papers. Someone to download and share this question. I don't know who will be in a position to do that very fast. You go to those links for past papers. I know you have them, and you download this paper from a file. September 2021, the question for a file, and you share that with the class WhatsApp group. September 2021, the question I want us to do is basically question 4B. Yes, so someone maybe to download that paper and please share that in the class WhatsApp group. Share that in the class WhatsApp group. Share that in the class WhatsApp group. Yes, I'm waiting for someone to share that paper from a file. September 2021. September 2021. Yes, is someone able to do that? Has the question been reshared? I'm waiting for that, for someone to do that. To share that paper. To share that paper. Yes, have you been able to get that question? I'm saying if you just need to use those links, the link for past papers. I know you have those links for past papers for downloading the past papers. You go to that question for September 2021. Question number, you just share the entire paper. Yes, I can see the question has already been shared there. I can see the question has already been shared there by Diana. Thank you, Diana. Thank you. Yes. Okay, so let's go to that question here. Let's go to that question. Let's go to that question here. September 2021. And basically, this is the question 4B. Question 4B. 4B. So what are we told here? What are we told? What are we told? The question reads, the following trial balance was extracted from the books of River Insurance as at 31st of July 2021. So we are given a trial balance there. We are given the premiums outstanding on 1st of August 2020. We are given the retained profit on 1st of August 2022. We have the share premium, ordinary share capital. We have investment income, account payable, management expenses relating to marine and fire. We have depreciation of non-current asset, direct asset remuneration, audit fee, freehold property, motor vehicle at net book value, equipment and computers net book value, furniture fittings net book value, financial assets, budget written off for marine for fire. We have the survey expenses on claims, equally for marine and for fire. We have the legal cost for marine fire, claims paid marine fire, claims outstanding for marine and fire, and an expired premium for marine and fire. We have the cash and bank balance, account receivable, direct premiums which were received, reinsurance premiums which were received, reinsurance premiums which were paid, and then we are given additional information about your total premiums of premiums outstanding as at 31st of July 2021 amounted to 14.4 and 6.4 for marine and fire, respectively. 2, the reserve for unexpired premium must be maintained at 100% and 50% of the net premium for marine and for fire insurance, respectively. 3, claims initiated and outstanding at the end of the year amounted to 7.2 for marine and 4.608 million for fire. 4, commission for both reinsurance ceded and reinsurance accepted is 5% of the premium. Number 5, provisions is to be made for the following: taxation, 4,152,000, ordinary dividends 5%, depreciation of motor vehicle 4.182, equipment and computer 2.16, furniture and fittings 2.4. What are we required to do? We are required to prepare the marine and insurance revenue accounts for the year which ended 31st of July 2021. Roman 2, statement of comprehensive income for the year which ended 31st of July 2021. And Roman 3, we are required to prepare the statement of financial position as at 31st of July 2021. So we will start with what is required in Roman 1, and basically we are required to prepare the marine and fire insurance revenue accounts. So let's start with that. We start with that. Basically here we will have the revenue accounts, and basically in this case, remember you have said that this account is prepared using a T format. Sorry, not T format, but rather a vertical format. A vertical format. So here we will have our two insurance businesses, and that is marine and what? And fire. I hope you can also be able to see that the figures we are given there are in what? Are in thousands of shillings. Are in thousands of shillings. In thousands of shillings. So what we start by recording here are the revenue, or basically the incomes, the revenue. Now, remember, we have said that the first revenue which we start with is basically the net premium. The net premium. So net premium automatically, this one is not given. We will have a working as far as that is concerned. And then to this, we have said we add the unearned premium at the start of the year. Now, these premiums which were not yet earned at the start of the year, they can also be known as the unexpired premium. Unexpired what? Premium. So because in our question here, we are not given an unearned premium, we're given something called the unexpired premium. Unexpired premium, these are premiums whose period has not expired. So we have said to this, we add the unearned premium. In our case, that one is known as the unexpired premium. Unexpired premium, premium basically at the start. That one should be added. And then to this, we less the unexpired premium. The unexpired premium at the end of the year. I think, first of all, we can record this one because it's given in the trial balance. I don't know whether you can see the unexpired premium at the start. That one is within the trial balance. In the trial balance, we are given the unexpired premium at the start. Can you see that? Somewhere down there. So the unexpired premium at the start for the first insurance business was 46,080. And for the other insurance business, this one was 24,000. I hope you can see those figures. So automatically, this one is not given, but we're given some information in relation to that in note number 2. Can we go to note number 2? In note number 2, we are told the reserve for an expired premium must be maintained at 100% and 50% of the net premium for marine and fire insurance business, respectively. So this one will have to be computed. And actually, we are told for marine will be 100% of the net premium. We have not yet computed the net premium. And this one will be 50% of the net worth premium. We need to compute the net worth premium. And basically, to this, we have said, then we need to proceed. And basically, we do what? We also include the commission on reinsurance ceded. The commission on reinsurance ceded. So I think maybe first of all, we can work out these items. We start by computing the net premium. The net premium. So for us to compute this, we need to prepare the premium account. We need to prepare the premium account. So let's prepare the premium account. The premium account, we will have the premium account for marine and basically for fire. The same case on the credit side for marine and also for what? For fire. Remember that is the credit side. This is the debit what? This is the debit side. So what do we record here? Or first of all, what do we record here? We start by recording the premiums which were outstanding at the start and also at the end. If you go back to the trial balance, you'll be able to see we are given the premiums which were outstanding. I don't know whether you can be able to see that. The premiums which were outstanding. The premiums which were outstanding. Are we given the premiums which were outstanding here? Because I can see that at the end of the year, in note number 1, we are given the premiums which were outstanding at the end of the year, which is basically note number 1. In the trial balance, we have premiums which were outstanding at the start, unexpired, the claims, legal, the burdens. Yes. Actually, that is the first item in the trial balance. And in that case, you have seen that the premiums which were outstanding, this one is basically an asset. That's why you can see that trial balance, it is on the debit side. That is an asset. So these are premiums not yet paid by the client, not yet paid by the customers. So it's an asset. 86 what? 40, and basically 67 what? 20. And then we record the premiums which were outstanding at the end. This is from note 1. From note 1, additional information number 1, which is 14,400, and basically 64 and 64. So that is basically what we have. What else do we record here? If you go back to the trial balance, especially down there in the trial balance, you'll be able to see some premiums which were, first of all, the premiums which were paid. The premiums which were paid, those ones should be, that is the reinsurance premium paid. Those ones should be debited here. That's why you can see even in the trial balance, they are on the debit side. They should be recorded in this account of the debit side. So for marine, 7680, for fire, 48. Then up there, I hope you can see we are given reinsurance premium received. Reinsurance premium received, you can see the trial balance, it is on the credit side. The same case here, the reinsurance premium received. So for marine is 11,520. For fire is 7680. Then equally above that, we have direct premiums which were received. So direct premium received, this one should also be credited here. Direct premiums which were received, that is 43,200 and 33,600. So we have dealt with those particular premiums. Anything we record in this account? No. So what we need to do then is basically we balance this account. The balancing figure, which is basically on this side, is the net worth, is the net premium. Is the net worth, the net premium. So let's do that. So we start by marine. We start by getting the net premium for marine. For marine, what are you getting? So we take what we have on the credit. Minus what you have on the debit. What are you getting? 52,800. 52,800. We do the same for fire. For fire, 7680. Yes, what are you getting? Yes. 36. 160. 36, 160. Yes, so that's basically what we bring here. The net premium for marine is 52,800, and for fire is 36, 160. 36, 160. So that is basically how we compute the net worth premium. So having done, then we can proceed and we compute this. The premium not yet earned at the end of the year, the unearned premium, the unexpired premium at the end of the year. So we are given information in relation to that in note number 2. We are told that reserve for unexpired premium should be maintained as 100% and 50% of the net premium for marine and for fire respectively. So the unexpired premium at the end of the year for marine will basically be 100% of this, 100% of the net premium. So 100% of that is 52,800. And this one should be maintained as 50% of that. 15% is what? 18 what? 080. 18,080. That's basically what we have there. Yes. So next, let's move and we compute this. The commission on reinsurance ceded. We have said this whereby the insurance company will be able to, will feel that the risk insured with that are too much. It decides to reinsure with another insurance company. It gives an insurance business to another insurance company. Our insurance company here gets a commission. So we have said this commission is always computed based on what? The reinsurance premiums which were paid. The reinsurance premiums which were paid. So that information we have it in note number 4. We are told commission on both the reinsurance ceded and reinsurance accepted is at the rate of 5%. At the rate of 5%. So this one will be at the rate of 5% of 5% of the reinsurance premiums which were paid. The reinsurance premiums which were paid, we have them here. We have them 10. So we get 5%. 5% in each case there. 5% times 7680, which will give us 384. I hope that is what you're getting. For the other insurance, for fire, we get 5% of 48. And we get what? Is it 240? 240. Yes, 240. Yes, and I think now we are basically done here. We are done. So what we need to do, can we get the total revenue for each insurance business? The total revenue for each insurance business. So this one will basically be simple, this plus this. This plus this. Is that the case? Yes. 46, 464, 46, 464. What about the other insurance business? 36, 160 plus 24,000 minus 18,080 plus 240. 42. Very good. 320. So that is the total revenue. So to this, then we less what? We less the expenses. We less the expenses. So the expenses specifically relating to fire, specifically relating to what? To marine. So I think here we have said we need to have a number of expenses. Starting with the net claims, we will have a working for this. That should be working 2. The other one is commission on reinsurance, basically accepted. And then from there, if we go back to the trial balance, we need to check now the specific expenses relating to, I think before we do that, can we first of all compute this? Because I think the computation of this is quite straightforward, even before you prepare the claims account. So let's first of all compute this one. The commission on insurance accepted. We have said this is a commission which will be computed as a percentage of reinsurance premiums which were received. What basically we have here. And it should be 5% of that. Should be 5% of that. 5% of 11,520. I hope that is a figure I'm given by Gilbert there. Yes, so that one would be 576. 576. What about the other insurance company? The other insurance business? It will be what? 384. 384. 384. I hope that is what you're getting. Okay. Yes. So then I want us to go to the trial balance. Before we compute the net claims, there are a number of specific expenses relating to each insurance business. We just first of all pick those expenses. So I think up there, I can be able to see we have management expenses. Can you see management expenses? And management expenses specifically related to marine and fire. So we first of all record that. Management expenses for marine, 6240. And basically for fire, 5568. So then we also have some expenses there, but they are general, right? Depreciation, like directors' remuneration, audit, those are general. They'll go to the income statement. Then down there, I can see we have budget written off, which were written off. For marine is 1632. For fire is 1152. Then we have survey expenses on claims. So these are expenses relating to claims. So any expense relating to claims, that one is captured when preparing the claims account. Is not recorded here as an expense for individual insurance business. So that one will go to the claims account. Below that, we have the legal cost. The legal cost for marine for fire. Is it 1728 and 1248? I hope that is those are the figures. I hope those are the figures. And then from there we have the claims. So automatically this will go to the claim account. The other one is the claim outstanding that will go to the claims account. I think down there we have an expired premium. We have used that. Yes, I think what we need to do, I can't see any other expense relating to individual insurance business. Do we have any other? Do we have any other? I can't see any other. So let's prepare the claims account. The claims account so that we compute the amount of net claims. So that we compute the amount of net claims. Net claims. Net claims. We compute the amount of net claims. So we prepare this for marine, basically for fire. Marine and also what? And also fire. So what do we record here? This kind of number of items. We will start with the claims which were outstanding at the start of the year, which is part of the trial balance down there. The claims which were outstanding. The claims outstanding, these are claims not yet paid by our insurance company. To the insurance company is a liability. So being a liability, it would be the opening balance in this account on the credit side. On the credit side. So the claims outstanding at the start for marine, 7680, for fire, 5184. And then down here, we need to record the claims at the end of the year. The claims at the end of the year. So the claims at the end of the year, this one we have it. These are the claims outstanding at the end of the year, given in note number 3. The claims initiated and basically outstanding at the end of the year was 72 for marine, and 4608 for what? For fire. For fire. What else do we record here? We go back to the trial balance. We have claims which were paid. Claims which were paid, I said the double entry for that is to debit this account with credit bank. So we have 23,712, and for fire is 17,280. The claims which were paid. What else do we record here? Any expense relating to the claim. So below those claims which were paid, actually above the claims which were paid, we have the survey expenses on claims. Survey expenses on claims. Those are basically expenses relating to who? To these particular claims. To these claims here. So we have 1845. And basically we have what? We have 1227. 1227. So we have dealt with those survey expenses, the claims which were paid. Yes. So I think now we are done. What we need to do is we balance our account, and the balancing figure on this side are the net claims, which we are going to recognize here as an expense. Which you're going to recognize here as an expense. Which you're going to recognize here as an expense. So let's start by computing the net claims for the first insurance business. For the first insurance business. I'm given those figures, you just need to confirm them. You just need to confirm those figures. Just confirm those, whether those figures are correct. Are those figures correct? Are those figures correct? Yes, yes, they are confirmed. So let's have those figures here. So we have 25,077, and then we have 17,93. Is there anything which we have not dealt with? I don't think so. I don't think so. So I think we can then get the net revenue or the net income, that is. Let's get the net income. The net income of each insurance business, Yes, so those are the figures I'm given. Just confirm whether they are correct. Just confirm whether those figures are correct. Are the figures correct? 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 Yes, yes. So confirmed. Okay, that is already confirmed. So I think now we can proceed. We can proceed here. Yes, so let's proceed. And basically we do what? We prepare what's required basically in part B of that question. That is Roman 2. We are required to prepare the statement of what? Of comprehensive income. Statement of comprehensive income. Comprehensive income. So which is for the year which ended 31st of July. 31st of July 2021. 31st of July 2021. Remember, this one we have said is basically prepared to do what? To ascertain the performance of the entire insurance business. Sorry, not the insurance business, but the performance of the entire insurance company, because this one is basically prepared to ascertain the performance of each insurance business. So this is how each insurance business performs. This is basically the net income. The net income of each insurance business. So this one we prepare it to determine the performance of the entire insurance company. So how do we prepare this one? We start by recording incomes of the insurance company. So in this case, we need to have two columns here. We need to have two columns here. Like that, we will start with the incomes. And always the incomes we start with here is the net income. The net income which was generated from each insurance business. So this net income which was generated from each insurance business. So the net income generated from marine insurance business is basically 11 to 11. The one which was generated from fire insurance business is 16,037. So what we need to do to this is basically we add other incomes. Were there other incomes which were generated by this insurance company? Was there any other income? So for us to be able to check whether we have any other income, we go back to the trial balance. We know that all incomes, they have a credit balance. So we check the items appearing on the credit side of the trial balance. So up there, I can see retained earnings, share premium, ordinary share capital. Those are items of equity, but I can also see investment income. Investment income, that is basically part of the other incomes, which is basically an amount of what? An amount of 2688. So down there we have account payable, that is basically a liability. Then I'll go down there because I'm only interested with the items appearing on the credit side. So down there I can see we have claims, outstanding and expired premium. We have dealt with all those. And then down there, you can see we have premiums which were received, we have dealt with all those. So in our case, automatically here, we don't have any other income. So what we need to do is we get the total incomes of this insurance company. The total incomes of this insurance company. The total incomes of this insurance what? A company. The total incomes of this insurance company. Total incomes of this insurance company. Total incomes of this insurance company. And I'm given a figure of 29,936. Confirm whether that is what you're getting. Yes, that is confirmed by Richmond Fair. Okay. So to this then we proceed, and now we less what? We less the expenses. Remember, the expenses which we less here are the general expenses. General expenses are those expenses which do not relate to marine and also what? Fire. They are general expenses of the company. They are not expenses of these insurance businesses. So in the trial balance, I think we have this kind of number of them. Maybe remember all the expenses, they have a debit balance in the trial balance. So starting from there where we have management expenses, remember that was a specific expense. Down there, can see we have depreciation on non-current assets. So, but in this case, here the examiner tried to trick you. So I hope you can see that depreciation. And also, if you go to note number 6, we are given the breakdown of that depreciation because whatever you're given in the trial balance has to be the total. So can you add the depreciation in note number 6 and you confirm whether it is coming to this amount here? Whether it is coming to 86, 88. The depreciation which is in note number 6. Is it coming to the figure we have there? Yes. So, but I will tell you why the information in note number 6 was given. That was just an examiner trying to trick you. I'll explain that maybe when preparing the statement of financial position. So below the depreciation, we have directors' remuneration. This is still an expense to the company. Directors' remuneration is an expense, which is an amount of 4752. So below that, we have audit fee. Audit fees is basically also an expense, 2304. So we have freehold property, we have motor vehicle, we have equipment, we have furniture, financial assets, all those are assets. And then I think we have dealt with all those the items, most of the items which are down there, including budget, survey, legal, claims outstanding and expired premium. We have dealt with all those. But cash and bank balance, that is an asset. And then account payable is an asset. Do we have any other expense? In the additional information, number 1, you have dealt with that. Number 2, number 3, number 4. Yes, I think we don't have any other general expense. Or we have any other general expense? I can't see any. So we need to get the total general expenses. We take them to the last column. And basically we deduct them from the total incomes We deduct that from our total income. So first of all, confirm whether you're getting such a figure. Huh? Are you getting? Is that what you're getting? Is the total expenses 15,744? Yes, yes. So we less that from our total incomes, and because this current company, we will get the profit before tax. We will get the profit before tax. So how much is the profit before tax? 14,192. 14,192. 14,192. So because this is a company, we must compute the tax. We are given some information in relation to that in note number 5. Provision are to be made for the following. So we are told a provision will be made for tax. So we are given the tax. So we left that here, which is an amount of 4152. 4152. So then we get the profit for the year. The profit for the year. The profit for the year would be 10, 0 what? 10,040, 10,040. 10,040, is that the profit for the year? 10,040. 10,040. Please confirm whether you're getting the same figure. So this minus that, yes. So then also in note number 4, we are told this company was to provide for dividends. Dividends we know are payable from the profit. So to this we will also less the proposed dividends, because those dividends were not yet paid, they were just proposed. Proposed dividends. So the dividends were, we are told, will be 5%. We are told it will be 5 what? %. So 5% of what? This one should be 5% of the ordinary share capital. 5% of the ordinary share capital. The ordinary share capital is 28,800. 28,800. 28,800. 28,800 should be 5% of the share capital. And that is giving us an amount of how much? That is giving us an amount of how much? Yes, it's giving us an amount of 1440. Then what we get down here is the retained profit. The retained profit for the year. So the retained profit for the year. The retained profit for the year, this one will be 86. Will be 86. So having that, then finally, we need to add the retained profit, or in other terms, the retained earnings, balance brought down. So these are retained profit or the retained earnings at the start of the year, and that is the figure we have in the trial balance. If we go to the trial balance, I hope you can see we are given the retained earnings or the retained, yes, the retained profit at the start of the year, which is an amount of 4320. 4320. So we add these two values, and they will give us what? They will give us what? They will give us 11,920. So this one, we refer to it as the retained profit balance carried down. So this one is basically a component of equity, is a component of equity within our statement of financial position. Within our statement of financial position, that would be what? That would be a component of equity there. Yes, so basically that is it. That's what was required as far as Roman 2 of that question is concerned. I want us to finalize by doing the last part. By doing the last part. I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Yes or no? Are we together up to that point? So that figure is 12, eh? That figure is 12. Is 12,920. 12,920. Yes, I hope you're together up to that point. So if that is the case, then we move and prepare what is required, the statement of financial position. Statement of financial position is that 31st of July 2021. 31st of July 2021. Yes, so here we just need to have a single column. And we will start by recording the non-current assets. The non-current assets. We start by recording the non-current assets. Now, in our case, we have various non-current assets. The first non-current asset which we have should be freehold property. I hope you can see that below the director's fees, below the audit fee, we have the freehold property. Freehold property. So the freehold property, the value for that is what? Is 40,320. Then below that we have motor vehicle. And actually what you're given here is the net book value. Can someone tell me now here? Because here the examiner, this is where the trick was. These particular net book values which are given here in the trial balance, are they the net book values at the start of the year? Are they the net book values at the end of the year? For example, that net book value for the motor vehicle, that is 3,600. Is it at the start? Is it the net book value at the start, or is it the net book value at the end? Net book value at the start or at the end? I'm told by this it is at the end. Is it at the start? Is it at the end? Is it at the start? Is it at the end? So these particular net book values which are given here is automatically at the end of the year. Why is it at the end of the year? The reason why it is at the end of the year is because I hope you can see we are given this particular depreciation for the current year. This particular depreciation is given as in the trial balance. And I hope you can be able to remember most of the questions you came across even at the lower level. You were not given the depreciation for the current year as an expense in the trial balance. The depreciation for the current year, you were given a note and you had to compute that, or it was given as part of the additional information. That's why you, the questions you did in the lower level, you had to compute the net book value at the end, taking maybe the net book value at the start and lessing the depreciation for the current year. But anytime you are given the depreciation for the current year in the trial balance, it basically means that those particular net book values you're given in the trial balance, this depreciation for the current year has already been deducted. Has already been what? Deducted. So therefore, don't deduct that, but you can see in this case, the examiner had tricked the student by giving that depreciation in the trial balance and also giving the individual depreciation for asset in note number 6. So that if you're not aware that the net book values you're given in the trial balance are at the end, you end up deducting those depreciation in note number 6. But I've said anytime you're given the depreciation for the current year in the trial balance, which is not a common scenario, and the net book value for the asset in the trial balance are at the end. So therefore, the motor vehicle, the net book value there is at the end, 33,600. So then from there we have equipment and computer. Equipment and computers. Equipment and computers, that one is given as 14,400. So then from there we have furniture and fittings. Furnitures and fittings, that is 12,480. And then below that we have financial assets. Financial assets, which is an amount of 13,440. And what are financial assets? Who can tell us what are financial assets? What are financial assets? What are financial assets? What are financial assets? In case you're given a financial asset, what are these? Marketable securities. What are these? Financial assets. Risk assets. Risk. Apana. These are not risk assets. These are not risk assets. Financial assets are what? This is something we came across in the topic of financial instruments. This is something we came across in the topic of financial instruments. We say generally what are investments? What are, okay, I think I've already told you that. Basically, if you're given financial asset, this is the investment. And that's why you can see up here, we had, in preparing this, we had an investment income. This is an investment. A financial asset is what? An investment, either in share or basically in debt instruments. Sasa? Yes. So that is an investment. So then down there, I think you have bad debt. We have basically debt with that. Legal claims outstanding. And I think what we have down there is cash, account receivables. Those are current assets. I don't think we have any other non-current assets. So let's proceed and record the current assets now. Let's proceed and record the current assets. We proceed and record the current assets. So for the current assets, we have the cash and bank balance. I hope you can see that almost at the bottom of the trial balance. And that is an amount of 1056. And then we have account receivables. The account receivables, which is basically 7008. Yes, I think basically that's what we have in the trial balance. But equally, in the additional information, we have a number of current assets. So number one, the premiums which were outstanding. The premiums outstanding is money which is not yet paid, which is not yet received by the insurance company from its clients. So the premiums not yet received is an asset. Premiums which were outstanding. This is an asset to the insurance company. The premium for what? For marine and basically for fire, which is 14,400, and then 64. This is an asset. So then we have the reserve for an expired premium. So the reserve for an expired premium, this one still will go to the balance sheet, but this one is a liability because this is like a premium which is already received, but it has not been earned. It's like an income received in advance. You have received some premium because the period covered has not expired. This to you is like an income you have received from your customers in advance. To the insurance company, that premium for unexpired, those unexpired premium, they will be a liability. So claims outstanding, claims not yet paid to the insurance company is a liability. And then we have the commissions here. There is one of the commissions which will appear here as an income, and that is the commission on reinsurance, on reinsurance accepted. Commission on reinsurance accepted. Remember, you have said a commission on reinsurance accepted. Is that the case? No. No, it should be the commission on reinsurance ceded. The commission on reinsurance ceded. Remember, our insurance company was supposed to receive this commission. This commission was not yet received. If it was received, it should be part of the trial balance. If it was received, it should have been accounted for. It was not yet accounted for. So therefore, this one is basically what is a current asset. So basically for marine and for fire. How much was it? How much was this? 384 and 240. 384 and 240. Then number 5, those provisions which were made, they are liabilities. And then number 6, we are done. So let's get the total assets. So you add for me all those assets, you give me the total. You give me the total. That is the figure I'm given here by Gilbert. Yes, so that is confirmed. So let's move and record equity. Equity, we record share capital and reserves. We will start by recording share capital. So the ordinary share capital, which is in the trial balance up there, ordinary share capital. So the ordinary share capital is an amount of 28,800, 28,800, 28,800. And then above that, we have the share premium. The share premium. So the share premium is basically 9,600. So then above that, we have the retained profit. Is that the retained profit which we record here? No. The retained profit which we record here is what we have here. This one, which is 12,920. 12,920. Yes, and then I think there we have investment income. We've dealt with that. Account payable. Yes, I can't see any other item of equity. So let's get the total equity. Let's get the total equity. The total equity, 51, 320. 320. Then we proceed, we record the liabilities. So we start by checking whether we have any non-current liabilities or any non-current liability. And I think in this question here, we don't have any non-current liability. Yes, no non-current liability. I think finally we record the current liabilities. We record the current liabilities. So for current liabilities, let's start with what we have in the trial balance. And I think in the trial balance, we only have one. We only have one item, that is account payables. That is the account payables. And basically the account payables is an amount of 3168. I hope you can see that in the trial balance up there below the investment income. Below the investment income, yes. So then in the additional information, number one, we have dealt with that. Number two, we have this unexpired premium. The unexpired premium, basically we said, is like an income which is received in advance for marine and basically for what? For fire. Can you give me those figures? I can remember one of it was 1808. The other one was 50 something. Those unexpired premium at the end of the year. I can remember this was 1808. The other one was 52,800. 52,800. Was that the correct? Is that the correct value? Yes. So we are done with that. And then number three, we have the claims which were outstanding. Claims outstanding. The claims outstanding for marine and basically for fire. So that is an amount of 72 and the amount of what? Of 4608. We are done with that. And then note number 4, we have the commission The commission on reinsurance accepted. Commission on insurance accepted. Commission on insurance accepted. Give me those values for marine and for fire. Commission on insurance accepted. So this is the commission which was to be paid by our insurance company as a result of receiving some insurance business. Is that the total glitch mode? 576 and 384. 384. Then note number 5, those two items have not been paid. The company has just made a provision. So provision, remember, is money which is set aside. We have provision for taxation. This tax had not been paid. And then we have provision for ordinary dividends. So those two items were not yet paid. So to the company, their current liabilities, 41.52. And basically this one was what? 14 what? The dividends, the ordinary dividends. 1440. 1440. Yes, I think we are done because note number 6 will not affect this. So, and basically that is what was required as far as that question is concerned, the preparation of the financial statements of insurance company, preparation of financial statements of insurance company. Yes, it is balancing at that amount of 143, 728. Yes, so that basically how we present or how we prepare the financial statements of the insurance of the insurance companies. So you may check for another question from those particular past papers for FRA. You should be able to get more illustrations, specifically from the teaching of I think 2021 backward. You should be able to see more illustrations on this. Maybe you can check for another one, and maybe you do it as your own exercise. But basically, we are done with that. So it basically means that now once we meet in our next class, which will be on Tuesday, I think we go straight to our revision. We start revising, but remember, we have not yet done something to do with the theories. I think we will create maybe a class on that. We go through those theory topics and maybe try to check on some of the questions from the past papers. Yes, and I think we also have something small on fair value measurement. IFRS 13, basically we'll be able to also create a time for that. But I want us, once we meet now on Tuesday, officially we start our revision. We start our revision because there are those students who have joined our classes basically for revision. Equally, please share with your colleagues, with your friends who are planning to sit for exams from 18th. That in case maybe they are not very prepared, or maybe they are preparing for that exam, they can be able to join us for our blocks, which now will be starting on Monday, 21st, basically for a period of 4 weeks, up to 16th of August. Basically, it means that we will have a 4-week revision. But I think what we will try to do once we meet on Tuesday, we will maybe first of all try to predict some of the areas which are likely to be tested. We will basically try to revise on those areas. We can be able to try and predict some of the areas which are likely to be tested. We will be able to revise on those areas. Our revision will we will try to emphasize on those particular areas, but also we will maybe revise any other area which you may feel that you are not comfortable with it. But equally, we have said we will create some time, maybe a class. We go through the theory topics. We try to look on some questions from there. past papers, and so on. So therefore, if you know someone who is basically preparing for this exam, who is your colleague, who is your friend, you can basically share this information with them that we will be starting our blocks from Monday. So we are charging just 2,000 for those who are not our students. And basically that will enable them to be able to access all the classes for what? For the revision. Yes. So I think we stop at that point for today. We continue from there on Tuesday. So Gordon is asking, what is there any special topic on journal entries? Gordon, I don't understand your question. Is there any special topic on journal entries? Journal entries, maybe, I think there is a topic we did on internal reconstruction. I think we had that aspect of journal entries. But journal entries basically is double entry. You may be required to do a journal entry, even the topic for financial instrument, the topic for share-based, and so on. So journal entries basically are double entry. So we stop at that point for today. Have a good evening. We continue from there next week on Tuesday.